So I've contemplated quite a bit on whether I should do a follow-up video on this whole episode around Alibaba's convertible bond issue. And I think it voices down to two main points. I think first things first, when I made the initial video, there was not a lot of details. So I wanted to basically give more context and to bring in different viewpoints from different people as well, to give you a fuller picture. And I think the second part or the second main point of this video, especially people that know me, they have personally texted me, PM me, DM me, etc., saying that, oh, Chikeng, when I saw your first video, you sounded incredibly bearish. Are you going to sell soon? Etc., etc. I think when I was creating that video and when I was editing it, I think I was running for that news cycle, meaning I wanted to be quick to update. That's why I didn't really took into account my tonality and how I presented it. And rather than saying I'm turning bearish or I'm frustrated or angry about it, I think my bigger emotion at play was this idea of being exasperated. So personally, I don't have a kid, but at least from how I look at this entire scenario and how everything has been developing around Baba, you can say that it is kind of my pet project, or it's my personal, something that I hold dear to my heart. And looking at how management has been executing thus far, it doesn't inspire me, it doesn't inspire confidence in me at all. So let's go back to this convertible bond issue. To me, when I looked into it at first, I thought that, okay, this is an interesting way of trying to conduct some sort of a financial engineering by trying to get interested bondholders by capping their downside or limiting their downside while also expecting them to be equity holders in the long term. And the $5 billion issue really seems like a joke, especially when I put things into context. Alibaba just last quarter alone has bought back $4.9 billion worth of shares. And also, they have more than, I think, $60 billion net cash position. And if you really took that position, why not basically just put your fist down on the table and issue up, let's say, a $30 billion convertible bond rather than a $5 billion that is probably not going to move the needle in the grander scheme of things? Are you really confident in what you're doing? And this $5 billion issue, it's not going to do anything much about. So now, this is the convertible bond update. So they're going to issue out an aggregate of around $5 billion due 2031. So that's a 7-year time frame with an interest or a coupon payable of 0.5% per year, payable semi-annually. So the conversion premium, I think, is roughly in line or similar to that of JD. That is 30%. So the strike price in this case is around $105 per share with a cap upside of 100%, which is 161. So the idea of a convertible bond, long story short, is that you buy a bond instrument, you get some sort of an interest, and if the share price happen to go above the strike, in this case 105, you can change it into an equity position, and anything above it, by the time of the deadline of 2031, you can basically enjoy the upside or the difference in terms of the market price and also the strike price. Now, I think before going into the different perspectives, I'm just going to ask you guys two questions. And I do look forward to your engagement and to your answers as well in the comments below. First question, if you currently have zero exposure to Alibaba today, will you be interested in this convertible bond? Meaning, I'm going to promise you an interest or coupon payment of 0.5%, considering the fact that currently the risk-free from the US Treasury is closer to 4 to 5%. So you're taking a significant haircut, but you get this idea of or you get this additional call option tagged to this bond component. So that's the first question. Second question, if you're currently already a shareholder, are you happy with this arrangement? Meaning the company is going to issue some sort of a bond, get in some amount of money, and then you might have a potential dilution at the $105 range because they have to basically make good of that convertible bond promise. So I wanted to get your answers in the comments below. So circling back to the actual results, the $5 billion convertible bond issued by Alibaba has received positive market response and was oversubscribed multiple times, according to people familiar with the matter. Institutions seems like they're extremely excited for this zero downside and call option-ish deal. And evidently, I think the two key pointers that we can take away is that they do trust Alibaba is undervalued. And I think in multiple videos, I've already said that even my grandmother knows that Alibaba is undervalued. And they can essentially participate in the upside risk-free. And on another note, they're essentially risking the opportunity cost that's going to be incurred here, especially the delta or the difference in terms of the risk-free rate that they can achieve, especially in this high rates environment. May is the lucky month for those of you who have yet to create a Weibo account. So for new users, Weibo is currently running a welcome promotion where you can get up to 1,050 US dollars worth of cash vouchers and also an exclusive Money Bull interest booster, which I'll talk more about later. So for a start, if you sign up for an account with the link below, make an initial funding of at least 2,000 US dollars and complete 3 US buy trades and maintain the fund until 30th of June 2024, you can get 200 US dollars cash voucher. Simple as that. So for those that wish to hit a higher tier, you can get up to 1,050 US dollars in cash vouchers when fulfilling the max requirements. Here's the exciting addition. So you can get to enjoy an exclusive 180 days 3% USD Money Bull interest booster. So this applies to the first 250,000 US dollars subscription in the USD Money Bull. And this 3% booster is on top of the yield from the USD cash fund in Money Bull. So the USD cash fund in Money Bull had a 7-day yield of 5.4% as of 25th of March 2024. Therefore, you can potentially earn up to 8.4% on your idle cash if you park it with the USD Money Bull for this promotion. So I think this really can't get any better. And for those of you who have not signed up for a Weibo account, link is in the description box down below. And let's go back down to the main point of contention. I think the biggest or the two biggest bear arguments or bear voices in the market today is really this idea of, I thought Alibaba is extremely cash rich. They have more than $60 billion in net cash position. They have not enough money. The balance sheet is fake. They cannot access the money. I think that's the biggest argument. And the second bear argument, which is my concern, is really how big is this $5 billion going to move the needle? I honestly don't understand the thought process here. But that said, I think when you look into online conversations, it seems rather positive. This is the Reddit thread on Baba. They said that, look at JD.com, they have to pay a 0.5% coupon and it's convertible for shares with a 35% premium. It's basically getting free cash, so why not? I'd take some free cash. And somebody replied to it saying that, if you think about it, they get the same 0.5% coupon, it's smart. They use $5 billion for buyback at $80 per share, means that they can buy back 62.5 million shares. And if the coupon gets used, I think what he says is if the convertible bond gets converted at the 35% premium, they are giving out 46.25 million shares in 2031. So that means that the shares outstanding gets less for 0.5% interest rate. So seems good for long term. So the problems that some Chinese companies have is that they can't convert all their cash to US dollars and do buyback with it. So even if they have $60 billion cash, they're not allowed by the CCP to use it all as dividends or buybacks. They can get around this by doing it with the bond. To me, when I first read it, it definitely doesn't sound inspiring, especially to somebody that is a potential Baba shareholder. What do you mean by they can't use it? So if it walks like a duck, it quacks like a duck, is it not the duck? Meaning if you don't have the cash, you don't have access to it, you can't allocate the capital, it means that the cash is not yours. There are probably many investors that have that same opinion, which I fervently disagree, and I'll explain later on. The ex-capitalist tweeted, so if you're a Baba shareholder, please repost this so haters can see and understand the latest fundraising. Number 1, they will buy back shares at low price and issue them to bondholders at higher price. And the difference or the delta is the profit. Point number 2, meanwhile, they can park the cash in marketable securities and make free money. Point number 3, straight senior bonds wouldn't work the same way because you have to pay the full amount plus interest. It doesn't allow you to do arbitrage in share buyback. So please don't make it complicated. It really is not. So I think the first point, I can understand this whole delta difference, and which goes back to my point again. If it's really so great, it's creating so much shareholder value, why stop at $5 billion? $5 billion seems like a joke, especially if it's a $200 billion enterprise, and you think that it's at least 30% undervalued. So if you add on a 30% premium again, so they should be worth at least 260 billion. So if that's your target price, then I think a sizable or a good enough convertible bond issue should at least be in the range of 30 and above. So why not just go ahead and do a $30 billion issue rather than start at? I don't know whether is it a start, whether they're going to raise even more money, but it seems like there's some sort of a demand and bondholders are taking it up. They want to take a bet on Alibaba. Why not fulfill this demand? I mean, that's my main point of contention or my own idea here. Now, on the second point about parking your cash in marketable securities and earning free money, I've took the liberty to actually dig out some information specifically about the interest income that Alibaba has been getting over the last 3 years. So based on the disclosure, this is the interest income for 2022, 2023, and 2024. And I've basically also pulled out the cash and cash equivalent, less the restricted cash and escrows receivable. And this is the amount disclosed in the balance sheet in the ending period. So the effective interest rate, this is the general percentage term. So this is just to give you a flavor in terms of what's the rate of return or the effective interest rate that they're earning in their marketable securities. And yes, if you compare the difference, issuing it at a 0.5% coupon, Alibaba definitely stand to gain here. And going to the third point about issuing a straight senior bond, it doesn't work the same way. And the last time Alibaba has raised some sort of a vanilla senior bond is back in 2021 of February. And they've raised multiple rounds. They had a 10-year one, a 20-year one, a 30-year one, and a 40-year one. And I believe back then, interest rates were rather low because the Fed basically brought rates down to zero to stimulate demand because of the pandemic. And what Alibaba did was also raise $5 billion with different tenures, and they just gave 100 basis point, which is 1% above the US Treasuries. And I think all things considered, issuing bonds at that environment was a good play in hindsight because of the low rates environment. So another opinion along the same lines, saying that by issuing a US dollar denominated convertible bond, the company avoids a costly conversion of their revenue in order to buy back stock because of the unfavorable exchange rate right now. And also, the company might potentially face a stamp tax when moving money out of China. And the consensus amongst most investors today of why they need to raise money in the US market, it's purely from constraints and limitations because of capital control. And from the CFO's explanation to analysts 2 earnings ago, they did already floated or telegraphed the idea that, hey, I can increase the leverage on my balance sheet and I have sufficient cash to do the buybacks. And I think to provide more color to this entire discussion around capital controls and restrictions around moving capital, there is a risk factor that's disclosed in Alibaba's annual report saying that PRC laws and regulations actually permits payment of dividends by the company's subsidiary incorporated in the PRC only out of their retained earnings. So in addition, the company subsidiary are required to annually appropriate 10% of their net income to the statutory reserve prior to the payment of any dividends, unless the reserve have reached 50% of their respective registered capital. It's a very technical term, but I think to just contextualize it in terms of numbers, the company, or Alibaba in this case, has performed a test on the restricted net assets of the consolidated subsidiaries and VIEs. So I think if you look at it, as of March 31st, 2024, in RMB, Alibaba has a total assets of around 1.2 trillion renminbi. So if you look at it on the other side, which is the liabilities perspective, I believe that the additional paid-in capital, which is around 400 billion, and the statutory reserves, which is around 15 billion, these 2 line items cannot be touched. And if you look into the wording, the payments of dividends can only come out of their retained earnings. And evidently, Alibaba is quite stacked on their retained earnings, close to $600 billion. So if you convert it to US dollars, it's closer to 80 billion. I would push back quite heavily onto the idea that Alibaba can not touch many of the assets on their balance sheet. I don't think so. But whether is it from a tax implication point of view, whether is it favorable exchange rate, whether there's a much more efficient way, which is to raise convertible bond to benefit more shareholders, I think these are all plausible, legitimate, and fair arguments. But like I said, my main gripe and my own observation is that I think the $5 billion scale is too small and doesn't inspire confidence. Now, on the second point is really this idea of capital control. And it's not foreign to shareholders. I think for people that did a serious enough study into the company and the broader environment that they're operating in, you are probably aware of some sort of capital control that China instituted on many of their companies. And it's not the case where you invest in a company and then the CCP basically just confiscate the retained earnings or confiscate the cash on their balance sheet. Of course, I'm not eliminating that possibility, and I think most investors probably already know what they signed up for. And because of the lack of transparency, uncertainty definitely lurks. But I think going back to the point about this idea of expectations versus reality, so if investors already come in with this level of expectations that, oh, it's not going to be very transparent, it's going to be slightly opaque, and you have to second guess things, it will be reflective in the stock price and valuations itself. Funny thing and interesting thing is, if you think about it, when Alibaba and Tencent was at their all-time highs in 2020 or 2019, a lot of things or a lot of all these risk factors and concerns are not even part of the priorities of potential or prospective investors. They probably didn't really care. But I think like the saying goes, when it rains, it pours. And when the share price doesn't perform, the stock is bad, the macro is bad, the earnings is bad, then people start to nitpick and then say this and that and to come up with very creative arguments. And I think the last part, which is a very casual conversation that I had with a friend, saying that, so why are you making yourself so tired? Investing into China is such a tiring endeavor. It's so different. The accounting standards is different. What do you mean by a statutory reserve? Why only coming out from retained earnings? They can just basically slap a huge fine and then the cash on the balance sheet can essentially evaporate. So I think everything in life, there's pros and cons. And as investors, we probably have to choose a hill that we should die on. And if the sentiments is not at rock bottom, if people are not questioning everything, then you wouldn't be offered such an opportunity with crazy valuations. And like Munger puts it, I still believe that if you want to count strength per dollar in terms of the business enterprise, the moat that they have, the earnings, the revenue, the profits, the free cash flow that they bring, divided by per dollar or per valuation dollar, I think Chinese companies, at least in today's depressed valuation, still offer some crazy level of risk reward. But of course, you need to take into account the many levels of risk and see whether you're comfortable or not. I think this whole episode of issuing a convertible bond, it seems like Alibaba is trying to find investors interested in buying Baba shares, bullish that Alibaba is going to appreciate in value, but don't want to expose themselves to the downside risk. And it seems like the demand is there, so like I said, I think that they should do more. Could this be the first of many other issuance? I hope so. But if not, if it's just a one-off, I issue 5 billion and then the next 3 years, nothing's going to happen. To me, as a shareholder, as a long-term shareholder, a long-time shareholder, I really don't know how much is this 5 billion going to move the needle. And yeah, then I don't really know the perspective and what's the philosophy behind even engaging into this in the first place. Are they really that in need of just 5 billion US dollars? That's my main gripe. So just a special thanks to SH, to Henry, to John, to Ahmad, and to Sam. So the 5 of you are amongst those that have engaged me the most during the weekends, share with me resources, share with me different quotes and stuff like that. So many thanks to you guys, and I hope that we have gained more clarity through this episode, and let's see how things will develop from here. So with that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye.